In 2008, American households lost $16 trillion in wealth in less than 18 months. If you had a pension, a savings account, or a mortgage that year, this is your story. Not because of a war, not because of a natural disaster, because a small number of people spent 20 years quietly dismantling the laws that stood between the financial system and total collapse. And when it finally fell, those people were not prosecuted. They were consulted. They were the ones called in to fix it. The bankers lit the match. You already know that part. Every documentary, every film, every news segment told you that part. What they left out is this: the bonfire. 20 years of quietly removed laws, of midnight exemptions, of regulators who became the regulated, was built in plain sight, in congressional hearings, with bipartisan applause, on the front pages of financial newspapers, celebrated as the future of American prosperity. This is the 2008 financial crisis. And this is the part they left out. To understand how the bonfire was built, you have to meet the people who built it. And you have to go back to a moment, 60 years earlier, when someone tried to make sure it could never happen. To understand what happened in 2008, you need to understand one thing about how American banking worked for most of the 20th century. There was a legal wall that existed for a very specific reason. Go back to 1929. The American stock market collapses. Banks across the country fail. Millions of ordinary people who had nothing to do with Wall Street, people who had simply put their wages into a savings account, lose everything. Not because they made bad decisions, because their bank had taken their deposits and gambled with them on financial markets. When the bets went wrong, the savings went with them. A senator named Carter Glass spent years watching this happen and warning anyone who would listen that mixing two fundamentally different kinds of banking was a catastrophe waiting to occur. Think of it this way. There are two kinds of banks. The first kind is the bank on your street corner, the one where you deposit your paycheck, where your grandmother keeps her savings, where a family goes for a mortgage. That bank's entire job is to be safe, boring even. It takes money in, it lends money out, it makes a steady return. Nobody should be gambling with the money in that bank. The second kind is an investment bank, the kind that exists on Wall Street. These banks trade securities, underwrite deals, take calculated risks with sophisticated financial products. They exist to make big bets. Sometimes they win, sometimes they lose. That is the nature of the business. Carter Glass looked at these two kinds of banks and said, "These must never be the same institution. If you let a Wall Street gambling operation sit inside the same building as an ordinary savings bank, using ordinary people's deposits as its chips, eventually something will go catastrophically wrong." So in 1933, Glass drew a wall between them. Commercial banks, your savings, your mortgage, your checking account on one side. Investment banks, trading, speculation, risk on the other. One could not touch the other. Simple, clean, permanent. It was called the Glass-Steagall Act. For 66 years, that wall held. America went through the Second World War, multiple recessions, the oil shocks of the 70s, the savings and loan crisis of the 80s. Through all of it, not one systemic collapse of the American banking system. Because the wall was there. Now. In 1999, the same year the internet boom was turning 20-something programmers into millionaires, and the idea that markets always go up had become almost a religious belief in American finance. Three things happened in Washington that together would make 2008 not just possible, but inevitable. The first was the wall coming down, the wall Carter Glass had built to keep your savings away from Wall Street's gambling. The second was the creation of a special type of financial insurance contract, one that could be written for hundreds of billions of dollars with absolutely nothing backing it. No reserves, no regulator checking the books, just a promise on paper. And the third was a decision, made in a meeting that lasted exactly 1 hour, to let the biggest banks in America borrow money at levels so extreme that a tiny crack in the foundation would bring the entire building down. None of these three things caused the crisis on their own, but together, like 3 gas leaks meeting a single spark, they created conditions where a collapse was not a risk to be managed. It was a mathematical certainty waiting for a date. Let's start with the wall. Sandy Weill was the CEO of Travelers Group, a financial conglomerate that owned an investment bank, a brokerage, and an insurance company. In 1998, Weill decided he wanted something more. He wanted to buy Citibank, one of the largest commercial banks in America, the kind that held ordinary people's savings, and merge it with everything he already owned. This would create the largest financial institution in the history of the world. There was one problem. It was against the law. Glass-Steagall, the wall Carter Glass had built 65 years earlier, made exactly this kind of merger illegal. Weill would be merging an investment bank and an insurance company with a savings bank. Exactly the combination Glass had spent his career warning about. Sandy Weill did the deal anyway. He announced the merger in April 1998, before the law had changed, before he had any legal right to complete it. in a bet that if he moved fast enough and spent enough money lobbying Congress, the law would be changed around him before anyone could stop it. The merged company was called Citigroup. It was technically illegal. Weil then spent the next 18 months and millions of dollars in lobbying fees pushing Congress to rewrite the rules. He met with senators and congressmen, he hosted fundraisers, he made phone calls, and in November 1999, President Bill Clinton signed the Gramm-Leach-Bliley Act into law. Glass-Steagall, 66 years old, the wall that had separated your savings from Wall Street's gambling since the Great Depression, was repealed. Sandy Weil had it engraved on a plaque and mounted it on the wall of his office. It read, "The Shatterer of Glass-Steagall." He was not embarrassed by this. He was proud. Now, the man sitting across the table from Wall Street's lobbyists during these negotiations, the man who was supposed to be representing the interests of ordinary Americans as Treasury Secretary of the United States, was a man named Robert Rubin. Within months of leaving the Treasury, Rubin joined Citigroup's board of directors. Over the next decade, he collected more than $115 million from the bank, whose creation he had helped make legally possible. He was later called back to Washington to help design the bailout of that same institution. This is not a conspiracy. Nobody broke a law. This is just the system. The revolving door between Washington and Wall Street that had been turning for decades, doing exactly what it was built to do. But here is what the wall coming down actually meant in practice. With Glass-Steagall gone, the biggest banks in America could now take the money sitting in ordinary people's savings accounts, your money, your grandmother's money, and use it as the foundation for enormous financial bets on Wall Street. The firewall between safe and speculative was gone, but tearing down the wall was only the first of the 3 steps we described. Because even with the wall gone, the banks needed 2 more things to build the bonfire to the scale it would eventually reach. They needed a way to insure those bets, to protect themselves if things went wrong, without anyone checking whether that insurance could actually pay out. And they needed permission to borrow far more money than the rules currently allowed, so they could place those bets at a scale that would make the eventual losses truly catastrophic. Both of those things were arranged in the 12 months that followed. The second thing the banks needed, after the wall between savings and speculation had come down, was insurance. Here's what that means in practice and why it matters. When a bank makes a large financial bet, it faces a problem. The people whose money it is investing, shareholders, depositors, pension funds, want some assurance that if the bet goes wrong, they will not lose everything. Normally, that assurance comes in the form of an insurance contract. You pay a premium. The insurer holds reserves. If the worst happens, the insurer pays out. But here's the thing about normal insurance. It is regulated. The insurer has to prove it holds enough money to cover what it has promised to pay. A government regulator checks the books. If you do not have the reserves, you cannot write the policy. In the year 2000, just 12 months after Glass-Steagall was repealed, Congress passed a second law that created a special new kind of insurance contract that was completely exempt from those rules. No reserve requirements, no regulatory oversight. No government body had any authority over these contracts whatsoever. They could be written for any amount by any institution, with nothing backing them but a promise. These contracts were called credit default swaps. To understand what they actually were, picture this. You own a house. Your neighbor decides to take out an insurance policy on your house. Not their house, yours. They pay a small monthly premium to an insurance company. As long as your house stands, nothing happens. But if your house burns down, the insurance company owes your neighbor the full value of the building. Your neighbor has no stake in your house. They do not live there. They do not own it. They are simply placing a financial bet that it will eventually collapse, and collecting a small fee from the insurance company for as long as it stands. Now imagine your neighbor does not do this with just your house. They do it with 10,000 houses simultaneously, billions of dollars in coverage promised on thousands of properties they do not own. And the insurance company writing all of those policies holds no money in reserve. They are simply collecting premiums, assuming the houses will keep standing, and booking the income as profit. What happens when the houses start to fall? The insurance company cannot pay. It has collected the fees. It has spent the fees. When the claims arrive, there is nothing there. That is exactly what AIG, the largest insurance company in the world, was doing. Except instead of houses, it was the mortgage bonds that the newly deregulated banks were about to start creating in industrial quantities, now that the wall between savings and speculation was gone. And instead of one neighbor, it was every major bank on Wall Street. These banks were buying mortgage bonds. AIG was insuring those bonds against failure, writing $440 billion worth of promises to pay, backed by essentially nothing, on products whose underlying weakness was not yet visible to anyone who was not looking very carefully. Alan Greenspan, the chairman of the Federal Reserve and the most powerful economic official in the country, told Congress these new contracts were self-regulating. The market, he said, would police itself. Government oversight was unnecessary. In 2008, after the collapse, he was called back to testify before Congress again. A congressman asked him directly, "Was your model wrong?" Greenspan paused. Then he said, "I found a flaw." That flaw cost the American public $182 billion, just to bail out AIG alone. So the wall was down, the unregulated insurance was written. But for the bonfire to reach the size it eventually did, the banks needed the third and final piece. They needed to be able to borrow enormous amounts of money to buy these products at the scale that would make their profits, and eventually their losses, truly catastrophic. That permission was given in a meeting that lasted exactly 1 hour. Now imagine you are allowed to borrow not 12 times your money, but 40 times. You have $10, you borrow $400. You invest $410. Now if that investment goes down by just 2.5%, barely a rounding error on a normal trading day, you're wiped out. You owe $400 you no longer have. This, in Wall Street lingo, is called leverage. At 40-to-1 leverage, almost anything can destroy you. The 5 banks asked for 40-to-1. The SEC said yes. The meeting lasted 1 hour. There was no public comment period, no vote in Congress, no independent review of the risks involved, 5 commissioners in a room, and the last meaningful constraint on how much the biggest banks in America could borrow was quietly removed. The banks did not wait. Within months, Lehman Brothers had leveraged itself 30-to-1, Bear Stearns 33-to-1. They took that borrowed money and poured it directly into mortgage bonds, the exact products that AIG had agreed to insure for $440 billion it did not have, inside a financial system that no longer had a wall between your savings and their speculation. All 3 pieces were now locked into place. The wall was down, the fake insurance was written, the borrowed money was loaded. Now someone just had to build the match, and that match was being struck at that very moment by a mortgage broker in Florida. Everything we have just described, the wall coming down, the unregulated insurance, the borrowed money, those were events in Washington and on Wall Street, in committee rooms and boardrooms, among people in expensive suits, making decisions that most ordinary Americans never heard about. But those decisions did not stay in Washington. They traveled down through the financial system, through the banks, through the mortgage companies, all the way to a strip mall office in Boca Raton, Florida, where a mortgage broker is sitting across a desk from a family who wants to buy a house. Picture that broker in 2005. His name doesn't matter. What matters? The only thing that matters is how he gets paid. He gets paid per mortgage, he writes. Not per mortgage that gets repaid. Not per mortgage that performs for 5 years without a missed payment. Per mortgage, he writes. The moment the loan is approved and the paperwork is signed, he collects his fee. What happens to that loan after that is someone else's problem. And here is the critical part. Because of what had happened in Washington, it really was someone else's problem. Here is why. Remember Lehman and Bear Stearns and Goldman, the banks that had just been allowed to borrow 30 and 33 times their capital? They needed somewhere to put that money. They needed assets to buy. And the asset they had decided to buy was mortgage bonds, bundles of thousands of individual home loans packaged together and sold as a single investment. To make those bonds, they needed mortgages. Lots of them. As many as possible. Which meant they needed brokers across the country to keep writing loans, and they needed those brokers to write them fast, regardless of whether the borrowers could realistically repay. So the broker writes a mortgage to a man who works part-time at a grocery store. Annual income, $28,000. Mortgage value, $340,000. Under normal circumstances, a bank that expected to hold this loan for 30 years would never approve it. But this bank is not going to hold it for 30 years. It is going to sell it within weeks. So the broker does not ask difficult questions about whether this man can afford the repayments. The broker does not ask questions. The broker gets paid when the ink dries. This is not a hypothetical. Loans exactly like this were written by the hundreds of thousands across Florida, California, Nevada, Arizona, across every state where house prices had been rising long enough that everyone had convinced themselves they would keep rising forever. Now watch what happens to that loan. The bank buys it from the broker. The bank then bundles it together with 10,000 other loans just like it. Loans written to other part-time workers, other families who stretched further than they should have, other borrowers the broker did not ask hard questions about. The bank packages all of these together into a single bond, a mortgage-backed security, and takes it to a ratings agency. Here is where the final piece clicks into place. Ratings agencies, firms like Moody's and Standard & Poor's, exist to tell investors how safe a financial product is. AAA is the highest rating. It means this investment is as safe as lending money to the United States government. No serious institutional investor would buy anything below AAA. And here's the detail that makes everything else possible. The ratings agencies are paid by the banks issuing the bonds. Not by the investors buying them, by the banks that need the AAA stamp to sell them. Between 2005 and 2007, ratings agencies handed out AAA ratings on $3.2 trillion worth of mortgage bonds. Bonds stuffed with loans to people who could not repay them, written by brokers who did not ask, assembled by banks that needed to keep the machine running to service the borrowed money they had loaded up on after that one-hour meeting in 2004. They were not going to say no. Their entire business depended on saying yes. That bond, stamped AAA, certified as the safest possible investment, is now purchased by a pension fund in Norway, a regional bank in Germany, a sovereign wealth fund in Singapore, investors on the other side of the world, buying what they have been told is rock solid, with no idea that inside it is a $340,000 mortgage, written to a part-time grocery store worker in Florida, insured by AIG through a $440 billion contract backed by nothing, held by a bank that borrowed 30 times its capital to buy it. Every person in that chain, the broker, the bank, the ratings agency, was doing exactly what the rules allowed them to do, exactly what their financial incentives told them to do, exactly what 3 pieces of legislation passed quietly between 1999 and 2004 had made not just possible, but rational. The machine was not broken. The machine was working exactly as the incentives had designed it to work. It was just built from the ground up to eventually destroy itself. And by 2007, the part-time grocery store worker in Florida had stopped making his mortgage payments. So had hundreds of thousands of people just like him. And every institution in that chain, the broker, the bank, the ratings agency, the pension fund in Norway, the regional bank in Germany, and AIG sitting at the end of the line with $440 billion in promises it could not honor, was about to find out what happened when the machine ran in reverse. It started, as most catastrophes do, quietly. In 2006, house prices in parts of Florida, California, and Nevada began to stop rising. Not crash, just stop rising. After a decade of seemingly endless growth, the market simply went flat. For most people, this was barely news. Markets fluctuate. Prices plateau. Nobody panicked. But inside the machine we have just described, a flat housing market was not a minor fluctuation. It was a death sentence. Here is why. The entire chain, the broker, the bank, the mortgage bond, the pension fund in Norway, AIG's $440 billion in insurance contracts, was built on a single assumption, that house prices would keep going up. As long as they went up, borrowers could refinance their mortgages if they got into trouble. As long as they went up, the bonds backed by those mortgages held their value. As long as they went up, AIG's insurance contracts would never be called. The moment prices stopped rising, that assumption broke. And once it broke, everything connected to it broke with it. The part-time grocery store worker in Florida, the one with the $340,000 mortgage and the $28,000 salary, could no longer refinance his way out of trouble. His monthly payments were already stretching him to breaking point. In 2007, he stopped paying. So did hundreds of thousands of people just like him. The mortgage bonds those payments were supposed to support began to lose value. Not gradually, sharply. The AAA rating that Moody's had stamped on them turned out to be worthless, because the ratings agencies had never seriously modeled what would happen if house prices fell nationally. It had never happened before in modern American history, so they assumed it couldn't. It could. By early 2007, 2 hedge funds run by Bear Stearns, funds that had loaded up on exactly these mortgage bonds, collapsed completely. Their investors lost everything. Bear Stearns told the public it was an isolated incident. It was not an isolated incident. By the end of 2007, the banks holding these bonds were quietly writing down billions in losses. Citigroup, Merrill Lynch, UBS. Each announcement was described as contained. Each announcement was followed by a larger one. And then in March 2008, Bear Stearns itself, one of the 5 banks that had walked into that SEC meeting in 2004 and asked for 40-to-1 leverage, ran out of money. Not slowly, overnight. In a matter of days, the confidence of the market in Bear Stearns evaporated so completely that the firm could not borrow enough to open for business. The Federal Reserve arranged an emergency rescue. JP Morgan bought Bear Stearns for $2 a share. A year earlier, the stock had been worth $170. The government told the public this was a one-off, a contained failure. The system was sound, but the system was not sound because Lehman Brothers was still out there, leveraged 30-to-1, sitting on tens of billions in mortgage bonds that were losing value by the day. And unlike Bear Stearns, Lehman was going to be allowed to fail. What happened next took 6 days. By September 2008, 6 months after Bear Stearns had been rescued, the rest of the financial world had convinced itself the worst was over. It was not over. September 7th, 2008. The United States government seizes Fannie Mae and Freddie Mac, the 2 institutions that underpin the entire American mortgage market. Combined liabilities, $5 trillion. The government has no choice. If they fall, every mortgage in America falls with them. September 15th, Lehman Brothers, 158 years old, the fourth largest investment bank in America, files for bankruptcy. $613 billion in debt, gone in a single morning. Outside the Lehman offices in Midtown Manhattan, 25,000 employees walk out of the building carrying boxes. Most of them are not traders or executives. They are administrators, analysts, assistants, people 1 or 2 years into their careers. Their pension funds are in Lehman stock. By noon, that stock is worth nothing. Tourists on the street take photographs of them. September 16th. AIG, the largest insurance company in the world, collapses. The government writes an $85 billion check before the markets open. By the end of the crisis, that number will reach $182 billion. The same day, a money market fund called the Reserve Primary Fund announces it has lost money. This has never happened before in the history of American finance. Money market funds are where companies keep their operating cash, their payroll, their rent, their day-to-day expenses. Within 24 hours, companies across America begin pulling cash out of money market funds at a rate that would empty the entire system in days. In Washington, Treasury Secretary Hank Paulson, former CEO of Goldman Sachs, gets on the phone with congressional leaders. He tells them, if we do not act within 48 hours, there will be no economy left to save. The ATMs will stop working. Payroll across the country will not be processed. The global financial system will seize completely. He is not exaggerating. 2 days later, Paulson walks into a meeting with congressional leaders to request $700 billion in emergency bailout funds. At one point during the meeting, he gets down on one knee in front of the Speaker of the House and begs her not to pull her party's support. The most powerful financial official in the United States, on one knee in the United States Capitol. That image is the end of the story that began with Carter Glass drawing a wall in 1933. The banks were bailed out. Every major institution was made whole. Goldman Sachs paid out $16 billion in bonuses in 2009, the year after the collapse, using money that included government support. Not one senior executive at a major Wall Street firm was criminally prosecuted for their role in the crisis. Not one. 8 million Americans lost their jobs. 10 million lost their homes. The median American family lost 39% of their net worth, wealth that, for most families, has never fully returned. During the savings and loan crisis of the 1980s, a far smaller financial disaster, over 800 bankers were convicted. The legal tools existed in 2008. The decision was made not to use them. In 2013, Attorney General Eric Holder was asked by a Senate committee why there had been no prosecutions. He said, on the record to Congress, that some financial institutions had become so large and so interconnected that prosecuting them could destabilize the financial system and damage the broader economy. The chief law enforcement officer of the United States had just told Congress in plain language that certain institutions were above the law. The men who designed the bailout returned to their lives. Timothy Geithner joined private equity firm Warburg Pincus. Ben Bernanke joined Citadel, a hedge fund that had profited during the crisis. Hank Paulson returned to private life, his Goldman Sachs fortune intact. The revolving door kept turning. And then, in 2010, Congress passed the Dodd-Frank Act, the most significant financial regulation since Glass-Steagall, designed to make sure it could never happen again. By 2018, significant portions of it had been quietly rolled back, lobbied against by the same banks, signed away with bipartisan support. 10 years. The cycle completed itself in 10 years. The bankers lit the match. The bonfire was built over 20 years, in committee rooms and congressional hearings, by men who moved between Washington and Wall Street so smoothly that, after a while, nobody could tell which side they were on. When the fire went out, they rebuilt it. They are still building it now. Subscribe to Fortune and Ruin as we continue our autopsy of history's greatest financial events. Let's uncover the financial truths that the history books left out. Your fortune depends on it.